Hi. Despite the tremendous political and economic uncertainty we saw in 2016, it actually turned out to be a pretty good year in the capital markets, and many of those trends we've seen continue into the first part of 2017. Equity markets, both in the developed and emerging parts of the world, were strong during the year, as were the fixed income markets across the board. This reflects improved confidence on the part of investors in increasing economic activity. And we see that reflected on the part of purchasing managers here, both in the developed and emerging markets, showing their confidence that economic activity is picking up. Inflation, on the other hand, while it's shown some signs of growing, actually has been largely driven by energy prices. And if we strip that effect out, core inflation has been pretty stable. And indeed, we could use a little bit more inflation in Asia and Europe in particular. To the rescue comes fiscal policy. After years of austerity, governments around the world are starting to spend more, and this should be stimulative to economic activity and push a little bit of that inflation forward. And this is good news as we hand off the baton from monetary policy over to fiscal policy. Rates have gone up twice here in the States so far, and investors' expectations are starting to close the gap and become more realistic that the Fed is going to continue to raise rates 2 more times over the course of this year. Now, that's actually not a bad thing for the bond markets. Rising rates reflect this improved economic activity, and indeed, if we look back historically, there hasn't been a period over the last 15 years where we've had bond markets actually sell off over 2 years. So we think people are overestimating that worry. One thing that we think you have to do is be a little bit more creative and selective in finding the opportunities, because the very large spread opportunity we saw in high yield markets has compressed a bit over the last 18 months. You're going to need to look a little bit to the emerging markets and elsewhere selectively to find those good opportunities to drive yield. But don't forget about the role that sovereigns play, both to provide you protection, but importantly, if you go outside the United States, you can pick up some of that carry and roll that's available to drive returns as well. So in sum, across the fixed income markets, be selective in your credit opportunities, look outside the United States and use some floating rate exposure to drive returns, but be balanced. Don't forget to add a little bit of duration in case things don't play out the way we like and to capture some of that roll down the curve. Now, rising rates are also a concern for the equity markets, but again, we think this concern is misplaced. Looking back, there's been 17 periods over the last 50 years when interest rates have risen, and equity markets have actually been up on average 12% across those periods, again, reflecting this much better economic activity that drives the rising rates. Now, a place for concern is the valuations we see in the market. They are high, and we've had a nice tailwind from low rates driving PE expansion as well as refinancing debt at lower levels, pushing up margins. Those tailwinds won't be with us going forward. We're going to need to see earnings growth drive returns, and you're going to have to be selective in finding those companies that can deliver that earnings growth. And an area where we see good opportunity there is in the growth markets. We see companies that have high profitability and the ability to reinvest that capital into their businesses, actually trading at a discount to the market today, offering good opportunity for many of our managers to find attractive investments. Another spot we see good opportunity, and this really stems from the expected tax relief we are going to see here in the United States, is small cap stocks. They disproportionately earn their money here in the United States and pay taxes here. Any relief they get and any repatriation of cash that can drive M&A activity will benefit those names. But again, you got to be careful and selective in there because there's a lot of names that are highly rate sensitive in utilities and REITs and elsewhere that will be hurt in this type of environment. Don't forget, however, that not all things may be rosy. We may have a downdraft along the way, and it's important to provide yourself with some diversification, and we urge you to carve out a piece of your allocation for alternatives that can provide that downside protection should things develop in a more negative way. So in sum, what are we saying? Be global. Look outside the United States for chances to find the best return opportunities, but be balanced. Don't reach too hard and be too aggressive. You need to have some protection in that portfolio in the form of sovereigns or other asset classes like alternatives to give you that protection in the rainy day. And be active. While we've been in a period where it's been a lot of stocks moving together, we see much more opportunity now for active managers to select the best opportunities out there, and we urge you to speak with our folks about that. Thanks, and I'll see you next quarter.